Welcome to the Jason De Sousa Show. Join us as we explore the evolving urban landscape, uncovering the trends, stories, and innovations shaping our cities. Thanks for watching and enjoy today's episode.
I always remember the introduction of build to rent as a concept in Australia, right? And it followed what was PRS, private rental scheme in the UK, which was sort of 5 to 6 years before us, right? And they were behind the US. And I would say, well, sort of rental in the US has always had a thing. It's always been a thing because people reflect on the time when, Friends was a huge TV show. And they would always talk about the super, like, well, what on earth is the super of the building? Like, who manages their rental apartment? And they talk about renting apartments. And I like your apartment better than my apartment, so I'm going to rent that. And it's like, and I don't think as Australians we really thought much about that.
Renting is beautiful.
It's now a thing, right? It's now people are now and that's actually one of the things I wanted to get into with you, which is the rent. Let's start there, right? The rental market. Dominated by mum and dad investors. Product quality. In strata buildings, but very low service quality generally. You'd have to sort of ask the agent to then ask the.
But in good locations.
But good locations. We must be about 3,000 build-to-rent units in operation in Australia, with another 6 or 7 maybe in the pipeline. I'm guessing you're the data guy.
15,000 done, kind of thing.
Oh, 15 done.
15,000 done.
Right. In operation already?
Yeah, in operation, but just to kind of put it in perspective, there's 1.6 million.
Yes, that's right. So
it's still a running error.
Still a running error, right? But I think that and now with the introduction of MIT for build-to-rent, a managed investment trust. We're now an equalization of international capital with domestic capital. That's opened up a capital pool, which I think we'll start to see more institutional grade build-to-rent come into the market. Is that what you're sort of seeing?
It's what we're expecting, but I think it's still very nuanced in that a lot of the BTR stock that's coming to market right now is still inner city. It's super high rise. So over time I would expect you'd get it in many different locations and of, different style. The product today that's come out is highly amenitized. Because you need that to sort of justify the rents that they want to charge. And so, BTR will have a place, but it's still
it's not going to be the dominant grade. It's not going to be the dominant
it's product. A certain lifestyle, right? Like do you want it? And for many people it's great. And there'll be others that want to live further out or have different social needs. And so I don't think it's one or the other kind of thing. I think both will sort of...
exactly. I always talk about that. I think there's a difference in typology and people have different needs for real estate at different times, and they'll rent or they'll buy or they might invest according to what their lifestyle is, and it isn't a competition.
Exactly right. And I think what people want most is a desirable location. So is it close to a train station or a beach or close to a school? And then price point sort of comes into it. And then what we did some proprietary research into this. We find pet friendly is super important.
Oh yeah, pets are a thing. Well, the law has changed to require it, isn't it? In New South Wales.
Yeah. And then believe it or not, internal laundry is a key tick.
My wife will love that.
Tick or cross. The property straight off if it doesn't have an internal laundry, and for many people, car parking. So
we're a family of 5. We had to upgrade our washing machine to deal with the amount of clothing that my 2 daughters and son generate. And I often tease my wife that her favorite device is the washing machine, which it isn't. It's the opposite.
Car parking, and then security. Kind of comes into it. I think especially for some of both the younger and the older generation, you've got building security and location security matters a lot. So
is your background before Australia Indian? Are you, So what I find quite interesting, I'm Goan background. There is and from Hong Kong, in Asia, there is a generational family living scenario, right? Where you do live with your parents, you do live with your grandparents. There is a intergenerational raising of children that isn't apparent in the UK or in Canada or Australia or even the United States to some extent. Do you think that's going to change? Do you think, given the way housing is going, are we going to see more of that in this market, or we're moving more towards single people living independent?
Yeah, I think people want their independence, and they'll figure out a way to make it affordable. We also find people are happy to share, but ideally, people would prefer to have their own space. So if you have studios, for example, or a single bedroom, people are very comfortable living in that. They want their privacy.
Yeah. So we're moving more in that direction.
Yeah, I think we're moving in that direction.
Which means we need more stock. Because you've got more solo living people in studios or one-bedders.
Yeah, look, and I think we need to also sort of appreciate that the younger generation it's far more mobile than the previous generations. They're happy to sort of move around, but equally they're far more wealthy in that they're high income out of the gate. So if you look at what a university student might be getting paid in their first year jobs, we find it's anything from 70,000 to 110,000
in graduate roles.
In graduate roles, right? 70,000 starting salary to sort of 110, maybe even a little bit more than that for certain professions. And if you're willing to, if you're in a partnership, for example, let's say you and your partner want to share a single bedroom apartment, suddenly you've got sort of $150,000, $200,000 household income firepower.
And you're paying $700-800 a week in rent.
It's affordable. Yeah. Right? It's affordable. And the same people also have other desires in life, right? Like people want to travel, see the world. They're into the health and fitness.
There's definitely a priority change between the generations, right? Generation X versus Generation Z versus millennials.
And I think when people talk about housing affordability, I go, it's also different priorities. Not everyone wants to become a homeowner at the age of 26, kind of thing. We've also got to take into account that people might be in their early 30s and actually would like to see Machu Picchu.
Well, so let's go to that, right? Because you're very bullish on house prices, right? And I love listening to you talk at many places, and we haven't had in fact, we should, before we get into that, I generally ask this on the podcast: how did you get into doing what you do, right? So you've got this job as head of research here at CBRE, and thank you to CBRE for hosting us. It's a cool job. You've just come from speaking at UTS?
Yeah.
Right? So straight into a podcast. So that's it, right into it. How did you get into this?
Yeah, look, my first job, by the way, was as a speech writer.
Oh, is that right? No wonder you've got so eloquent in your speaking.
I'd say I'm pretty straight talking. Is my sort of style. And then my first couple of career roles were in company analysis, working in strategy, consulting, and then...
So you've always been a data guy?
Data guy, and finding something in the data that no one else is seeing is kind of what I really enjoy. And that took me into sort of equities research, spent sort of 15 years there. Probably one of the best things I've done, because it makes you...
Equities?
Being an investment analyst. Because you're always looking at things from is this thing going to make money or not make money? And is the news incrementally better or worse kind of thing? You don't care about the news, but you care more about incrementally, is it better or worse?
Geez, it'd be fun being an equities analyst right now, wouldn't it?
Oh, yeah, right. But
and the contrarians are the ones who are probably making money.
Yeah, and you've got to also at the same time be very intense. There's not too much time wastage. You just sort of get on with it. So and then I turned sort of 50 in 2020 and decided I wanted to change industry sectors and career track. And so I joined kind of CBRE as head of research. Part of the role is managing people, which is something I enjoy, and managing a team. And then a large part of it is, just understanding real estate markets, also trying to figure out where they're going. And
that's the key, isn't it? The where it's going question is always the one that I find fascinating.
Yeah, and I think you've got to kind of real estate has long lags. between when a market starts to disappoint and then supply crashes, and then the market recovery starts as prices start to sort of go up. So you've got these long lags, and you've got to be able to look through patches. So don't get too exuberant when everyone else is exuberant, and don't get too bearish when everyone is too sort of negative.
Well, this is the thing, and I find in not just in real estate, but in most markets, when people go bearish, they go really bearish, right? And there's an overshoot, an overcorrection, and that overcorrection is where the sort of the good investors start to come in, and they start to the good investors, in my mind, the clients I work with in our firm, it's always about what are the fundamentals of the business that they're investing in? What are the fundamentals of the asset or the project that they're investing in? Are those fundamentals actually good? If they're good, then you have the sort of market elements on top of that, and the debt market there, or blah blah blah, right? But the fundamentals have to be good, and I've seen a lot of projects, particularly in real estate, where the fundamentals aren't good. And in the good times they get capital anyway. And then you have sort of tougher times and excellent quality projects that struggle to find capital. Which I shouldn't complain, because that's when they call us, right? So
no, exactly. But look, and I'd say one of the big lessons coming into this industry has been the importance of location. So a lot of people have been very sort of, or tend to have views around sectors: office good, office bad, residential good, residential bad. I find it is very important to start with the location and then look at the sector. And it could be country, city, sub-market, like a precinct. Each one can show you quite different outcomes. So, for example, you could be an office investor in Brisbane and things are fine. You could be an office investor in a sub-market that's not doing great, kind of thing.
But 5 years ago, no one would have said Brisbane office would have been good.
Right.
Now,
it's great.
People love Brisbane office. People are enjoying it, right? I mean, Melbourne office is a different question, but
so
Brisbane.
I always go Jason, start off with some of the location stuff. Understand the macro around the location, like what infrastructure is coming through, what does employment look like, who is getting employed. I think the who matters. We have been looking at some employment data around each of the different CBDs. And the hiring activity is very different. In some CBDs, there's a lot of retail and care worker hiring activity. In others, it's accountants, lawyers, technology people, bankers, people who can afford to pay higher rents. And even when they move into residential, can afford to pay higher price points. So I kind of go, look at the location and, get into the micro and the macro around it. Where the jobs, what does the employment situation look like? What does the infrastructure look like? If you look at Australia right now, every state has a very different property tax burden as well. So you can kind of
led by our Victorian friends. Right?
Like, but you can have a view on Australia, but actually to unpack it, you kind of go, South Australia has minimal property taxes, kind of thing. It's a very attractive city or attractive market. What's going on in hiring activity? What's going on in infrastructure activity? So, and then kind of bring it down, narrow it up.
And do you, when you look at that data, look at the split between public and private sector employment? Or does that not matter from a real estate perspective?
Oh, I think it does matter.
See, I think so.
And even within private, we will break it down by sector, because there are some jobs that are inherently high paying. And so, if you look at residential markets or office markets, even retail, that are co-located in those high paying spaces, they tend to outperform over time when those jobs are being created. So we watch, what are the types of jobs, and then we watch the incremental, which is, are those jobs being added or deleted?
See, I look at things and what worries me a little bit, and I'm keen to understand your view here on the health of the Australian economy, because I look at the last few years and the job growth in our country has largely been driven in the public sector.
That's right.
So we're, 75% or something, don't quote me on the number, you would know better than me, new jobs were in the public sector.
Yeah.
And that is not a good sign in
Yeah.
my mind. That tells me that the public sector is crowding out the private sector.
Yep.
And now we're starting to have a debate about whether this is a good thing or not.
Yeah.
And huge growth in healthcare, in disability care, in
Yeah.
aged care, in welfare, in the welfare sector.
Yeah.
That is driving a much larger welfare spend in our economy that
Yep.
perhaps we're able to afford.
Yep.
Which is sort of, I guess, characterized by our budget deficit and our growing
Yeah.
debt position. So I look at that and I go, yes, the fundamentals of real estate are good,
Yeah.
but
Yeah.
what are we looking at?
Yeah, look, and with these new jobs being created in the care sector, what it has meant, though, is it's cushioned the economy. So, like, residential, for example, particularly in the outer suburbs in most cities, have performed really well.
This is sort of master plan community product.
Yeah, master plan, or like, if you think about Sydney, like in the Hills District, for example, it's because that's where a lot of the care sector workers live. If there is a part of the economy that is getting a boost, we're okay with that sort of thing, because we want to actually understand how is that going to influence real estate in parts of the economy where that particular group of people is doing really well. And so, if retail, residential, in markets where there is a lot of care sector employment, has perhaps done better than if that government stimulus was not there, for example.
Yeah, and that makes sense.
Yeah, right.
Yeah,
so I kind of stay away from commenting too much on policy. Instead, I care more about, now that that's done, what does it mean for real estate?
But I guess my question is more: is it sustainable? Because I get that it's benefit.
Yeah.
I agree. I think
Yeah.
that's absolutely correct, right? I think the creation of the Sydney Metro line has also contributed to a lot
Massively.
of that. Massively, right?
Yeah.
We're advising on the Sydney Metro West line right now.
Yep.
I don't think people realize the impact that's going to
It'll
have
be huge
on the real estate sector across that line. Property values, in all of those station areas that have been unserved up till now, are going to change. And you only need to look at the evidence base of the existing line to the Hills District and things like that have shown that, right? Imagine Tullawong as a place. Anyone conceive Tullawong would be a hub?
Yeah. Look, in anything that's kind of close to or on top of train lines, they sort of outperform 1% a year is our rough number.
Really?
1% a year, every year. And, we had a look at what happened in Dubai and London with new train lines and metros. And you find rents are better, higher. Yeah. But you also find real estate outperforms 1% a year every year. So over 10 years, you're 10% ahead. 20 years, you're 20%.
And how far from the metro stop?
We normally, run a sort of 5K circle.
5K?
Yeah.
Wow.
Yeah. So
that's bigger than I thought.
Yeah. You kind of want to, because, you're kind of looking at the length and breadth of a suburb.
Yeah, right.
So like if there's a metro going through Chatswood, for example, you're looking at the entire Chatswood LGA.
Right.
Or postcode and saying.
And so within 5K, you're finding outperformance by 1%.
Yeah, absolutely.
Wow.
Look, and there's lots of infrastructure in Australia that'll drive real estate values. The metros are really important in Sydney.
Lily's taking notes for her next investment property.
And in Brisbane, right? And then you've got, I think Western Sydney Airport is a big.
That's the KSA is going to change a lot of things,
right? And then you've got AUKUS related.
Western Sydney Airport rather than KSA, but but KSA. What I was trying to say there was KSA has shown that when you look at if you look at the performance of all those residential projects around KSA,
they've done well.
They've done very well.
Yeah, look, and because these airports tend to be big employment hubs. I think I read a long time ago, there's about 20,000 people that are directly employed.
Yes, by an airport. Yeah. It's crazy.
Right, so you've got that, and then, AUKUS will be a big employer, and then, the Brisbane Olympics will be a big employer. Jason, there's one negative from all of this, which is, it's putting a massive amount of squeeze on construction labor.
Yes, well, that's good. Let's go to that because that's something that, you posted a very good, not at all.
Sorry.
you posted a couple of great charts on the escalation in construction pricing, and that was pre-Iran.
Yeah.
And I think there is a huge issue there because there's a accelerating gap between construction price escalation and revenue on projects. So what are you seeing there, and what are your concerns about that?
Yeah. Look, so we've got a formal estimate, and I'll give you some anecdotes around it. Our formal estimate is that construction will become 18% more expensive over the course of this 2-year period. Put simply, like if something was going to cost $100 at the start of 26, it'll cost $118 if you start at the end of 2027.
Wow.
Right. So, and that becomes a new base. It doesn't deflate, and it then inflates from that new 118.
So an 18% escalation effectively in 1 year.
Yeah, 1.5 sort of years.
And that's being driven now by
oil.
Yeah.
Much higher, like transport, moving cement and bricks and running the cranes. About 5 to 10% of the cost of a project is directly linked to this transportation. And then about 50, 60% is raw materials, like cement is linked, right, with energy costs, so steel, glass, PVC pipes, paint.
Yeah.
Paint is actually made from petroleum.
That's right. And pipes, I saw, what was it, 25%?
Yeah.
Or
right?
more?
More. Yeah, more. Yeah. And so these prices will, and already are moving up. But it was in early March. I was in a couple of meetings, and a few developers said that many of their subcontractors had already started to push, in the range of kind of 10%, maybe up to 15% price hikes through.
Yeah.
Because the people don't want to get caught out.
Understandably, right?
Yeah.
You look at the number of home builders that went under during COVID, and post that, when the price they struck was just not before they were handing contracts back.
Yeah.
Right.
So you got the shortage, fewer sort of contractors, prices sort of going up. It'll become tough. And then, Jason, we've also had, a couple of interest rate rises. It's kind of taken some of the heat out of the market.
Yeah. But turnaround, right? And we had 3 cuts and everyone celebrated, and now we're 2 back, and we'll probably get another one soon. And,
And so, I kind of go, it's going to put a serious handbrake on the amount of supply that's coming into the market. I think our own guesstimate kind of thing, before the Iran conflict, we thought housing supply would be about 20% down in the next 5 years compared to the last 10 years.
Supply,
yeah. If there's 100 apartments being built every year in the last 10 years, in the next 5, it's 80. That's our bottom up. We look at every developer, we kind of probability weight them, and that was our number kind of thing. And now, with what's gone on with the Middle East conflict and these high construction costs and the effect of high interest rates, that down 20 could quite easily be down 30, down 40, down 50%. Right?
Wow.
But if you think about it, like if you're
well, it makes sense.
It makes sense, right? Like let's say if you were thinking about a project that was going to come to completion in 2028, you're just about to get started, you're going to sit back now and have a really serious think. Because my construction cost is about to jump 18%. Most of it is probably already, you're seeing it in the tenders that are coming in. You can see a softer resi market in the short term based on some of the data because of the increases in interest rate. So you'll probably pause. And your pause may become a full stop.
In
many cases.
Well, we're seeing that now, right?
Yeah.
There are plenty of projects where just they're not stacking.
Yeah.
Right? And developers will say, I had one say to me the other day, we're not looking at anything under 25,000 a square meter.
Yeah.
Now, most people can't afford 25,000
right.
square meter, right?
This used to be like 10.
It used to be 10, right?
Yeah.
And, suburbs that you would think would trade sort of at 10. Like I had a guy come to me the other day at, what was it, Strathfield, 19,000 a square meter, they're pricing.
Wow.
like, really? 19,000 a square meter. You know, you've got stuff out Liverpool way that's trading at sort of 10.
Yeah.
Even that, and of course, nothing will stack with the construction price at sort of 6, right? 5 or 6. So that supports what you're saying in the sense that, you know, we were already behind on supply.
You're right.
We're going to fall even further behind on supply. We've got governments intervening anywhere they can now to try and increase supply. So if you look at New South Wales, they're rezoning lots of things. There's HDA, housing development authority, I think it's called, to try and get up zonings up, reducing council interference and red tape. That doesn't develop a project. That just tells you can get the height, you can get the yield, right? You've got the Housing Australia Fund that's in there, putting out loans to the community housing sector, saying, you know, come and do basically build to rent, not for profit, build to rent. Again, it's all debt financed. You might get projects off the ground. You probably will get projects off the ground, but they'll be expensive to supply affordable housing as a consequence of all of this, right? And you know, I think that's really tough for the government because the governments, because they want to address housing supply, particularly in the bigger cities, right? I think some of these housing pressures are less of a case in some other places, but certainly in Sydney and places like that, in Melbourne too, all of them have housing affordability questions to some extent. But I want to get to this, so I get the supply point, but I guess I go to the question of affordability. Yeah. Which is, and you see this constantly, you know, it used to be 2 times earnings to buy a house. Yeah. Right, to save a deposit, 2 times your salary, 3 times. Now it's 13 times. Yeah, that's right. It's completely, it's well beyond the capacity of somebody to borrow anymore. Young people have lost hope. This is the narrative. Lost hope. So they are choosing to raise wealth other ways. They're investing in the stock market. You know, they watch all those same podcasts that we were talking about earlier. And they've given up on property, and they're now going to be renters. And the Parisians are renters. Look at that. You know, they Europeans rent. You know, the Dutch rent. Is the home ownership question here under debate in Australia? The sort of idea that we should own property, and is it unaffordable for the broader market, or is this a sort of twist on a long-term narrative around affordability generally? Because remember, in the 50s, people were saying housing was unaffordable too. Yeah, right. So it's always that sort of narrative sort of persists. You know, Australian cities are still relatively affordable compared to a lot of their peers globally, is one point I'd make. And, you know, I'd say in many ways, Australian cities were underappreciated. In kind of a global context. The second thing, Jason, is, you know, I think when we do these like price earnings or price income metrics, people are taking an average value, like an average household income and an average apartment price, and there is no average kind of thing. So, you know, I'd kind of go back and say, when you peel that away and you look at segments, there is very strong affordability and there is lack of affordability amongst segments. So tell us more about that. Yeah, so like, you know, if you take the example of, let's say there's a lawyer and an accountant, they're in a couple situation and they're in their mid-30s, it is highly likely that that particular household is generating $350,000, $400,000 a year. They can afford to pay $2,000 rent and live on Bondi Beach. Happily. Happily, right? Yeah. So, but that segment is not being captured when you're doing averages. You know, if you do an average, you just assume a household's $100,000. Yeah. And the average rent in Sydney is, call it $700, sort of thing. But what I'm saying is there are pockets. And these are large segments, by the way. We find most segments in Australia are large buckets of population. You've also got people, you know, using that price income ratio. Many people are first home buyers, but there's also a range of people who are upgrading or downsizing. A lot of the market activity is those two segments. And if you're an upgrader, you're coming at it with very significant, in some cases, home equity. From your previous starter investment. From your previous, like, or you could have bought a place,
you're living in it for 5 years. You have a family. You decide you want a bigger place, but you sell your first one to but you're coming at it with equity.
And most importantly, it's tax-free equity in this country. Right?
Tax-free equity. So what I've done and what we're finding more and more is it is better to go out and just do segmentation.
Yeah. Rather than broad brush commentary.
And I'll give you an example, right? Like there is one of the interesting anecdotes we have is one of the most attractive market segments is downsizers in Castle Hill, right? Because it is a slightly older demographic. There's a large part of the population that's over 65 that is a homeowner in that market. They often have large homes that maybe they're willing to sort of downsize, and they're high price point. Yeah, those homes have a very high price point. So if you harvest that downsizer market in Castle Hill, you'll do well. They might be looking to move into a nice apartment in that location.
And also that means they get to stay near their family.
They stay near so we kind of go, it's segment by segment, work out these segments, and then build product that works for that segment.
And are you seeing the market follow that trend? I know what my answer is, but I'm curious to see.
There's a couple of bifurcations going on. Like nice downsizer apartments was not a concept in Australia sort of 5-10 years ago, but now you are seeing, well located, good apartments with good amenities that you would quite happily sort of downsize into as you turn into your 70, 75 years old kind of thing. And so that is a new trend. You've also got a trend of, people looking at studios as their first place to rent. We call it co-living. It's a very attractive offer.
They don't call them studios anymore. It's co-living.
It's co-living, right? Like, and it's a good thing.
Institutions like co-living too, right? I just came from a couple of meetings about co-living, and investors like them too because the equity check sizes are bite size. In
so I kind of go like if you're looking at co-living, or you're looking at build to rent, or you're looking at build to sell for downsizes. Each one of these is a micro market, and we'd say let's do suburb level analytics around how big could this be and how should you build it. Is it 20 apartments or 200? What's the price point? Who would you attract into it? So I don't think that affordable.
Is that what you do for clients here? Do you do it more broadly for selectively?
Selectively, right? Like if someone's really interested,
they'll ask you.
Hi, I own a shopping center. We're thinking about converting it. What do you make of this? What do you make of this? What should we think about? What are the options? So you'll just run some, but the decision is yours. You're the investor.
I find with we act for a lot of sort of investors coming in and working with counterparties, right? Australian counterparties. So in fact, we worked on a couple of deals in that sort of Castle Hill area. Great, and can totally endorse what you say there, right? And the investor did too for that reason. Broadly, what I sort of find is they like working with really high quality counterparties here, and they do like these subsets. So the narrative around a particular real estate sector, right? And so if you go and say I've got an apartment building, I'm going to build this apartment building, and it doesn't have the location, it doesn't have the amenity, it doesn't have the narrative, it doesn't have the target set properly. Not going to be funded. And there's a lot of that stuff around. There is a lot of that stuff around. Whereas those projects that have those things that you've just described tend to be the ones that are funded because they've got strong demand.
Look, and Jason, there'll be a little bit of this, but I'll go back to something we said early on. I'd also look at employment in those locations, particularly if it's like a co-living or a build to sell, or even build to rent. And you're going away from the CBD, I'd say keep having a look at, where do the people in that location work? Are they care workers? Are they in IT? Are they in banking, professional services? Actually, it kind of brings me to an interesting point. In the last 3 to 6 months, many clients have been asking us about the impact of AI.
Yes, well, I was going to ask you about that. You beat me to it. Did you read that Citrini Research piece?
I haven't read that piece. I have just been in and out of, it comes up in every meeting, basically. And I think many people start off with a sort of bearish assumption around AI. And this started with office market.
Yeah, they started with office, right? So I should, just for the audience, I should say what the Citrini thing said, right? Which basically said that AI came in and disrupted middle-class jobs, white-collar jobs, accountants, lawyers, whoever, all of whom have mortgages.
Right.
And they were no longer able to serve those mortgages. As a consequence of that, it led to, a depression in sort of real estate prices across the board. And isn't it, everyone was driving Uber, and then even that became a price competition, and no one was earning, and AI took over and the world died, basically, is the argument. That had an actual impact on the market, right? People actually reacted to this. And this was a hypothetical, right? So this was a hypothetical. Some analysts came out and said, look, AI is going to take over. Others said, this is ridiculous. It's not anything like this. So that's the context of the Citrini Research thing. But I'm curious you brought it up. I'm curious to see what you're seeing in the data around this.
Look, so we've been monitoring. Fundamentally, I think, I look at this as what are we seeing in the data on white-collar employment? Because if someone is getting hired, then that is a person that needs a piece of office space. That is a person that's then going to go out and shop and maybe take out a mortgage or rent a place. And the data is so I'd say to everyone, one, we're starting with a very low unemployment rate in Australia. Unemployment is in the low 4s. And many of us had predicted unemployment would rise over the last 2-3 years. And it's been very, very sticky, right?
It hasn't happened.
It's been very sticky.
And that's despite record migration.
Yeah, right. And so I want to just share what we saw in the last quarter. Because, AI is now embedded. It's not like a thought process. Most companies have deployed it, have been deploying it. It's in experimentation or very heavy usage, just depending on.
Are you guys using it here?
Yeah, absolutely. Yeah, absolutely. And what the data showed was really interesting, which was in the last quarter, there was 69,000 more professional services workers in Australia. So the number of lawyers, accountants, architects, etc.
There's more of them.
69,000 more of those.
We need more lawyers? I'm just joking.
In the last quarter, right? Compared to the quarter before.
That's extraordinary.
But there was 10,000 fewer technology workers, right? And to your point, there was a lot more care sector workers. But the number one job ads in terms of more jobs added into the economy in the last quarter was professional services. Now,
so that's fascinating, because if you listen to the news on this, you hear consulting firms are cutting people.
Yeah, right.
I saw a line recently that PwC partner pay was up because they'd got rid of people, and therefore there was more revenue available to partners, that sort of thing in the AFR. But you're saying that that's actually maybe the case in some consulting firms, but that's not the case.
69,000 more jobs. You will kind of appreciate this as well. Today, if you try and do a building development, just look at the amount of environmental consultancy reports you need to generate compared to 5 years ago.
And I wonder though, I go back to the productivity question on some of these things, right? Because I go, okay, where our firm, and a lot of my friends and colleagues who work in sort of advisory, we live in friction, right? Where we solve friction.
Yeah.
But surely AI gets rid of friction, right? So surely, yes, there's more jobs now, but surely AI will come along and disrupt the friction.
I think it'll help with certain processes. We find it helps with some level of data extraction. We still interpret the data ourselves quite frequently, and then how do you want to express the data? We tend to do, or at least I tend to do, by myself. So AI is playing a role, And what I'd say is there's been stacks of technology along the way. By the way, one of the biggest game-changing technological innovations in the last 30 years was XL5.
Yes.
Right.
Yeah.
People forget XL5 was a needle mover. Natural language processing, this predictive text, was a game changer in productivity. Mobile internet, which meant that suddenly you could do banking on your phone and not have to go to a bank branch, was a huge productivity driver. But despite that, the number of finance jobs in Australia has gone from 300,000 in 1990 to 600,000 today. It is doubled. Despite all the tech innovation. In lawyers and accountants, we've gone from having 400,000 in 1990 to 1.4 million today.
Wow.
Right? And I can tell you, accounting, law, these jobs have seen significant enhancement from technology, whether it's using Ansarada, using Salesforce, using OneDrive to share documents, whatever. There's been huge productivity changes from technology, and AI is another level, but it's just a journey on a journey. And I'll go back to, I'll keep watching that data that I just shared with you, that 69,000 more white-collar jobs were added in the last quarter. Not white-collar, professional services jobs were added in the last quarter. Those people will need office space. That's a lot of office space, by the way.
So obviously you're quite bullish on office then, right?
Right.
And if you look at the market at the moment, I think driven by the construction price question we were talking about earlier, office is great in terms of buying existing buildings. You can buy some beautiful buildings right now. The REITs are still recycling. You can buy some great tier one buildings, and capital is doing that.
Yeah.
But on the development front, we're not really seeing new office come by, right? I'd say we've got like 55 Pitt, Mervex 1 is doing pretty well. That's a beautiful building. There's a couple of new developments coming up, but overall,
there's a supply hole, right?
There's a supply hole.
And Jason, I just express it as in 5 of the next 6 years, maybe 7 years, there will be no new office development.
Which means we're subletting, right?
I just think it'll become really, really tight because even though when you look at things like vacancy, let's say Sydney vacancy is 13%, Melbourne's about 19%.
Yeah, which is higher than normal.
Yeah. But even that vacancy is heavily concentrated. So a large part of the stock is fully let or very close to fully let. So vacancy is an average, but there's a large part of the office stock, probably the most desirable office stock, that is running at a very high occupancy level. And for any tenant who wants to move into that location, in some ways you're going to have to pay overs. And that drives rent growth for those particular office assets. But in the short, medium term, there's going to be minimal new development of office supply. And I think that's good discipline, by the way. I think vacancy needs to trend back down. Some of the incentives need to come out of the system.
Yeah, I mean, we're seeing crazy incentives, right? 40, 50%.
And the best stuff in Sydney is like 25 as an outer marker. And then on the other side, the highest incentives are 45 to 55.
Yeah.
In some of the other cities. So the maths needs to sort of find an equilibrium, and the equilibrium will be through lack of supply, because I keep going, the price is not right. In office, in residential, right? Like developers can't build in resi at today's price point.
No. And
so supply needs to drop, and rents and pricing for apartments needs to move up. But the maths.
But there will be some locations where the maths will never work for new development.
That's great. And so, those markets will see less and less supply. Vacancies will keep tightening.
Yeah.
And that's life kind of thing.
No, I see what you're saying, right? I see where it stacks it stacks.
Yeah.
Where it doesn't, it doesn't.
Like in office today, Sydney's probably the market where it's closest to stacking, though it's not stacking, but it is the closest to stacking. And then it's tougher in Melbourne.
Yeah.
It'll be tougher in Parramatta, sort of thing, where you've got higher incentive levels. Those markets typically are harder to kind of stack up.
But Parramatta is a great example, right? Like if you look at it, there will be a metro stop there will be a high-speed rail stop there.
100%.
10 years, 15 years, we will not be having this discussion about Parramatta not stacking.
Look, I think the more...
less than that.
Yeah, look, and the more residential you add into Parramatta as well, I think it'll make Parramatta more vibrant.
Absolutely.
I think the vibrancy is one of those things that's been sort of lacking. And so anything that can be done to sort of activate.
Well, I mean, I've been a long-term advocate for Parramatta because I look at Parramatta Square is fantastic. Right? Lang Walker did a wonderful job there, and was a believer when nobody else was. He, the late Lang Walker was one of the great real estate leaders. But it's called Parramatta Square, but it isn't the centre of Parramatta. It isn't actually the centre. And you have it's still, the city is still disjointed between the shopping centre at Westfield and the and Parramatta Square, and what's lacking is the metro site.
Yeah.
The metro site is the game changer for Parramatta, and it will link everything up.
Yep.
And once that comes through, I mean, the metro finishes in 2032.
Yeah.
It will change the way Parramatta functions, and it'll be 18 minutes from the CBD. Right?
Yeah, look, and throw in all the resi stuff that'll get built around there. I think you get more human traffic, and you get this vibrancy, which is you get more people coming into office, and it's like a circular.
But if you talk to a developer about Parramatta today, they'll just go, well, "Yeah, I get it," but. It's not on my current radar.
Yeah, look, I'd say all the metro stations are worth a good kicking of the tires. Canterbury Bankstown is a market we like.
Yeah, Dulwich Hill.
Yeah, Macquarie Park was kind of thing, still is, and all along the new Western Metro. But it'll be the same in every city. I'd say watch the Cross River Rail. In Brisbane and the impact that'll have.
What's your sense of the Olympics on Brisbane? Is it just infrastructure jobs, or is there sort of a post-Olympic?
I think it'll do well post-Olympics as well. It's a city that'll become increasingly globally relevant. And
why do you think that?
I think many of these cities, Barcelona, Calgary. Were not as well known until they hosted the Olympics.
Oh, interesting.
And today if I say Barcelona to you, you know exactly what I'm talking about.
I think of tapas.
Yeah, right. And Calgary, right? And so I think it's the same. Like people's knowledge of Brisbane and Southeast Queensland more broadly. Yeah, people will come to appreciate.
I love Brisbane. I think it's just a wonderful city to be in. And it's also because it's Queensland. There's just a bit of a more relaxed feel in the city. Yeah, I just think it's wonderful. And it's a wonderful place to be. And whenever we have work there, I sort of look forward to going there.
Yeah, look, in one of the markets we're super bullish on is two markets that might surprise some of the listeners. One is we like Gold Coast apartments.
Yeah, who would have thought 5 years ago it would be saying that, right?
We like Gold Coast apartments, and I really like Southeast Queensland logistics.
Yes.
I think
we like that too.
Yeah, right. I think it's land constrained.
Can we talk a little bit about logistics?
Yeah.
So industrial was sort of the forgotten cousin last 10 years, right? Last 3 or 4 years, all of a sudden cap rates really compressed.
Yep.
Everyone's getting into industrial. We've gone into this period of time where people were sort of renovating sheds and making them more pretty and adding some solar panels and then putting them back in and at higher rents. But not a lot of new development yet. Again, construction pricing hurting us there. We're at record low vacancies now, probably in industrial.
Yep, 3-ish%.
3-ish, which it's pretty much zero, right?
Yeah.
So lots of people looking at land. What do
Yeah.
you think the forecasts are for industrial?
Yeah, look, so industrial 2026 is a slow year in terms of rent growth. Incentives have sort of crept up a little bit in logistics as there's as people try and lease up stock. This is particularly the case around sort of Western Sydney, around the airport, where there has been more construction done recently. But we get more constructive on it through 27 and 28 because that supply wave starts to fade again. And I think, the higher construction costs because of the stuff in the Middle East impacts resi market first and logistics markets. They're the front end because they have shorter development cycle where projects get pulled.
Do you think we are experiencing some of the demand from sort of this just-in-case supply chain, or we need to onshore our own stuff? Is any of that narrative coming through in the data?
A little bit, not enough, Jason.
Yeah. I wouldn't have thought so. It's not so easy to just build your own supply chain. Yeah.
And look, I think one of the things we think will become very important in logistics is access to power, because in the next, over time, more and more of the stuff in the warehouse becomes robotics led. And if you have a warehouse that is largely automated with robotics,
you need to power it.
Yeah, and you need about 2 to 3 times more power than it has right now.
And that's interesting. Everyone talks about data centers being the power consumer, but not your regular run-of-the-mill DC.
No, but the basic logistics side, if you're going to run robotics in it, you need, because you're charging them 24/7. You're operating them 24/7.
Yeah.
So just like there was a flight to quality, we're kind of telling everyone recently, there's going to be this flight to power. Because it's very hard to get access to power, right? Like it's 2 to 3 years lead time to get the wires and get the power sort of provisioned into your logistics site. I think, Jason, it's also this flight to power is important in residential.
Yeah, I agree with that.
It'll be important in office, right? AI and some level of how much workload is getting done in the office is going to be sort of, they're power hungry. Your home, you probably will have a couple of robots. And
well, the domestic robot seems to be around the corner,
right?
Isn't it?
And so the power requirements are accelerating in all forms of real estate.
And what's interesting about that is the real estate investors now, they are, a lot of funds have multiple types of investments within the fund, right? Real estate and your infra investments increasingly are kind of coming together, right? And so you do see the sort of power guys come in and say, we could do that private power line. We can do private transmission, private funded gas, private funded solar, and that'll go plug into all this other stuff we're investing in over here. And there's more of a portfolio investment approach that's sort of coming forward, which I really love. I think it's kind of how you would do an infrastructure project, right? Which is quite different to sort of when I started in this game a few years ago, where everyone was quite siloed and those infra guys know what the hell they do, and the real estate guys, whatever, right? There seems to be more interface.
Talking about that, like personally, I got some brand new solar panels put on our house in Jan. And
I presume we got the battery as well.
Yeah,
right?
we got a battery as well, and so
did we.
Yeah, it's kind of interesting, right? Like just watching.
My wife is obsessed. She just sits there. I'm like, is there some financial problem I'm unaware of? Like, what is going on? It's just
no. I find like by 10 or 11 a.m. the battery is getting almost fully charged.
Yeah,
and then it drains from 6 p.m. to sort of 11, and then in the morning, at this point, we're back on the grid. It seems to kind of drain overnight.
You know, what's fascinating in the power market is because of the massive uptake in rooftop solar in this country, we're now in a position where the government is saying they're going to offer power for free in the middle of the day.
That's right.
Because they've got to offload some of this power. So people will use that to charge up their batteries for free.
Yep.
And then they will use that to charge cars or whatever else. So it could be that all of that rooftop solar, for a domestic point of view, is used to charge your robot or your multiple EVs or whatever, right? It could be that the EV itself, and I mean, I went to a presentation on this, gosh, it would have been at least 15 years ago, saying the EV itself will be the future battery.
Yeah.
That the EV will not just be able to power itself, it will power your house.
Yep.
And it's a movable battery. These things are all sort of coming to fruition. I mean, I do think on the power side, it's becoming evident now that a renewable-only led strategy is difficult.
Yeah.
I think that would be fair to say, and that we do need to look a lot more at gas because we've got it. And there's a lot of people arguing a lot of cases around fossil fuels generally and nuclear and whatever else. But I personally come from a sort of technology agnostic viewpoint. Like, what is the cheapest way of providing,
But you've got a battery.
Power source? But we have a battery, absolutely. We do. Yeah. We've got a battery. We've got an EV. We've got and it's great. They're fantastic, absolutely fantastic, right? So I do think your point around power for the robotic DC, for the data center, you look at the amount of consumption a computer does to run AI. You can hear the computer trying to use every mite of its memory to try and get the AI to function. So I think that's something we don't talk about enough, this question, and how it impacts real estate. Like, are buildings even set up properly for the level of power?
I think the flight to power is a theme well worth sort of putting on your radar. I think there is a case for some premiums to emerge for buildings that are already provisioned. And I'm talking about warehouses, maybe shopping centers that are already provisioned for higher power loads. But aside from that, Jason, it's just, let's just keep an eye on the supply stuff. I think we'll see quite a big hollowing out of supply of real estate that's kind of delivered in the next 5 years. We were broadly sitting at 20 to 50% down on supply, 20% down in resi, 25% in logistics, about 50% lower supply in office. This was all pre-Iran.
Which is just going to intensify.
Yeah, right. And so I don't think I'll change my view a lot more on office and shopping centers, like in terms of the hollowing out. But I do expect we'll start to pull the supply numbers down on logistics and residential. And how much anything will probably cut another 10 to maybe up to 30% off the forward pipeline.
Wow.
As developers kind of start to, like I said, pause or put a full stop.
Which from an investment perspective is fascinating.
Yeah. So, built stock that's already out there. I think, people will be surprised with where rents go.
Well, a lot to think forward to. We'll probably have to end there. It's been wonderful having you on. I hope you'll come back on again because I think all the stuff we're talking about is so dynamic. It's moving so fast. So it's been fascinating to hear it. So Sameer Chopra, thank you so much for being on the podcast.
Thanks, Jason. Thank you. Thanks to the listeners.